Disappointing news in today's ADP jobs report for October. The payroll processor reported that private companies added just 130,000 jobs this month, fewer than forecast, as the 16-day partial government shutdown and debt limit standoff appeared to slow an already weak labor market.
And that's one reason that the Federal Reserve decided today to continue its massive bond buying program to give the U.S. economy a boost. Wrapping up a two-day meeting, policymakers at the central bank forecast weaker growth ahead and said the Fed will continue its stimulus program and keep its key interest rate at 0%. The Fed's statement signaled that the economy continues to improve, but only modestly.
Well, investors pored over the Fed's policy statement and seemingly didn't find much to hold on to. Stocks, of course, set a lot of records yesterday. Maybe they were just tired today, and that's why they sold off. It's probably as good an explanation as any. The Dow was down 61 points, the Nasdaq off 21, and the S&P was lower by 8. Prices on 10-year U.S. Treasury notes were lower today. Yields spiked higher to finish at 2.54% after the Federal Reserve wrapped up that two-day meeting.
Joining us now to talk more about that Fed meeting and the markets, David Kelly. He's Chief Global Strategist at J.P. Morgan Funds. So, David, really no surprises on that Fed decision. Everybody was kind of expecting it. But there was speculation that one of the reasons that the markets stayed in the minus column was that there was speculation that maybe Ben Bernanke will begin this whole tapering thing before he steps down as Fed chief anytime between December and January. What do you think?
I think that's possible. I don't think anything in this statement would have said that. I think that the only piece of news in this statement is that they removed language which they put in the last time around, which said that they were worried about rising interest rates. If you recall back in September when they decided not to taper then, what they said is that they were worried that rising interest rates would actually slow the economy. They removed that language. Now, if you think about it, back then, the 10-year Treasury yield was about 2.7%. As of this morning, it was 2.48%. So what they're really saying is 2.7% we're a little worried, 2.48% we're fine. But if the Fed's fine at 2.48%, then why should people buy a bond at 2.48% expecting rates to go down any further? So I think that's really why rates moved up a little bit, and I think that probably hurt the stock market. But overall, there's not a lot of news in today's statement.
You know, 6 weeks ago, David, I can't remember a more eagerly anticipated Fed meeting. Today's Fed meeting had none of that drama. Are you expecting that there will begin a pulling back of the bond purchasing sometime over the next 6 months? And will it be by Ms. Yellen or Mr. Bernanke?
Well, yes. And the second answer is it's a close call. But I think the key trigger here is actually got to do with the other side of Washington. I'm confident that the economy will pick up enough. I'm confident the unemployment rate will come down enough to justify the Fed tapering. But the real issue is, will we have an extension of the debt ceiling? Will we deal with another potential government shutdown in January? If we can have the government fully financed through 2014 with no issue on the debt ceiling, then I think that removes the last impediment to the Fed beginning to taper. They do need, they've got a long, long way to go to get back to normal, and they really need to get going. And so if in January, in the middle of January, we do come up with an agreement in Washington to fund the government and to extend the debt ceiling, then I think it's possible that with Ben Bernanke's last meeting at the end of January, that's when we'll begin to taper.
And there's no question, trimming back this stimulus, this massive stimulus, is going to be tricky. I mean, it's fraught with a risk. So if it does fall in the lap of Janet Yellen for the most part, what are the key things that she has to do so that in no way do those actions disrupt the markets and the economy?
Well, the first thing, of course, is they need to get started. But I think they shouldn't overstate the value of QE in helping this economy, because this economy has not really been doing that well. I mean, it's still only growing about 2% since the start of this expansion. And removing all this QE won't really hurt the economy that much either. So I think the Federal Reserve needs to express confidence that the economy can grow without this stimulus, and then just, get going and allow us to get back to a clear path towards normal. If people felt the Federal Reserve was getting back to normal, they might get back to more normal decisions on businesses and investing, which would actually be a good thing.
The S&P 500 is up 24% this year. How much of that gain is directly attributable to what the Fed's been doing?
I don't think a lot of it is. We have seen in the last few months more money going into equity funds, presumably because people feel there's no opportunity in fixed income. But for most of this rally, money has been moving out of equity mutual funds, even as the equity market goes up. And that suggests to me that it's not really QE that's been pushing the market up. It's just the market was too cheap. And so professional investors recognize some opportunity there. I still don't think the market's overvalued, but I think that if you keep the sea of liquidity growing here, eventually the market will become overvalued. And that's one other reason why the Fed needs to get going right now, to make sure that this thing doesn't get out of hand.
Okay, we're going to have to leave it there. David, thank you so much. David Kelly, Chief Global Strategist at JP Morgan Funds.